Welcome back to my channel. My name is Victor, and in this channel, I wanted to talk about CVS, review their earnings, and try to understand why the stock market's selling this stock off. The stock is off 17% just in one day. Is the company that terrible, or is it just being sold off without too much reason? I'd like to find that out. This is one of the stocks that I believe is underappreciated and has been discounted for some time. Am I wrong? I'd like to take a look at my analysis and see if I made a mistake or if I want to double down and continue to buy shares in CVS. I'll take you through that process and share my analysis with you. I hope you find it interesting. Before I jump into it, just a reminder on all my videos, I'm sharing my investing journey, my own experience. I am not providing financial advice. I'm not recommending you buy CVS stock or sell it or any stock that I ever cover. I don't recommend you buy or hold. I'm just sharing my experience and I hope you find it interesting. CVS is in the healthcare sector and they operate a couple of different businesses within that sector. First, they're probably best known for their pharmacies. So, a big retail business selling things related to healthcare, including a big pharmacy business. Second, they're a healthcare payer running an insurance company that provides healthcare coverage for many people. And third is they're beginning to provide health services in their locations. So you can go in and see a doctor, see a nurse practitioner over usually smaller items, not like emergency room kind of procedures or any type of surgeries or operations. It's really primarily for, hey, I've got a cold, I've got a flu, I'd like to go see the doctor, or something light that you would otherwise go to an urgent care. So it's interesting how they're integrating that type of business so that they can provide more to the patient and keep more of the revenue that's involved in all those different businesses. The business is has a market cap of $70 billion, and that has been marked down. It's been discounted. They pay a really nice dividend of 4.75%. That's a really nice dividend. Over the past year, the stock is down about 23.39%. And just today, the stock is down 17%. Today is Wednesday, May 1st, and the stock's really being punished. Amazing. I'm going to take a look at the earnings and try to see what investors are really disliking and driving the stock price down. As we look at their financials, the company has been growing year after year, just a solid grower. I really like that about them. The other thing that I like is they're a cash flow generator. Cash from operations has been consistently high. It has been going down. I think they're investing quite a bit in the health services business they're trying to establish and grow. And the CapEx isn't too extreme. Looks like in 23 it's 3 billion, and I'll take a look at the first quarter of 2024 to see how much CapEx they're spending in the business. So good CapEx, excuse me, good free cash flow generated by CVS. They've been growing their top line. That looks good. Several analysts cover this stock. I think a total of 22 analysts, and this is really hasn't been updated since they announced these earnings that were quite bad, I guess. And before that, we had 6 analysts saying strong buy, 12 saying buy, 4 saying hold, and nobody was a seller. Isn't that interesting? 22 analysts. They all believe that the target price is 60% higher than the current stock price. I think that's the biggest percentage higher in analyst reviews that I've seen probably in the past year. Well, that's interesting that a lot of analysts believe the CVS business is that discounted. Interesting. Let's take a look at their earnings per share. Earnings per share for 2024 is expected to be $8.39. Interesting. That's a pretty good number. I think they were light on earnings per share in their earnings report. I'll get to that in a minute. But they also are expected to keep growing that earnings per share. So really nice growth in their forecast. And overall, I'm going to put this data into my evaluation or my valuation model to see what the stock is worth based on earnings per share. Also see what it's worth based on free cash flows. So the earnings report and the press release that they announced, let's take a look at that. Then we'll dive deep into CVS earnings. So for the first quarter of 2024, their revenue went up 3.7% compared to the same quarter last year. Now that's a little lower than their typical growth rate, but it's growth, which is good. Earnings per share is where I think a lot of the heartache has existed. Earnings per share of 88 cents, and it was expected to be higher. Adjusted earnings per share $1.31. I think it was expected to be higher. It generated good cash flow from operations, but I think the CapEx may have been a little higher. The guidance also made a big impact on the stock price. You see earnings per share guidance of at least $5.64. It was previously $7.06. So I think that's what's really making people upset. And the adjusted earnings per share went to $7, down from $8.30. So I think that's what's driving some of the heartache. Cash flow was taken down. Cash flow from operations, they took it from 12 billion down to 10.5. So I'll use these reset numbers in my valuation, and I'll be conservative because I think management, when they bring down numbers, it really does speak to the public, and they're saying that, hey, we're struggling a little bit. We're not doing as well as we thought we were going to do, or we're not executing what we thought we were going to be able to do. So I think it's communicating a little concern, and certainly the market's reacting to this markdown of their earnings going forward, of their earnings per share, and then the bringing down the cash flow also makes people nervous. Let me examine the actual conference call presentation that they used to announce everything. I think they put a lot of good information in here. One thing that I do like about CVS is I believe they're very transparent. They share everything with the investors, so we know what we're getting ourselves into. So the CEO and CFO, they had their opening remarks. We talked about the revenue growth, which looked good. They are profitable, although not as profitable as they would have liked. One thing that is lost in all of this is they bought back $3 billion of shares. Okay. Think about their market cap, 70 billion. They bought back $3 billion of shares. That's a very high percentage of shares being bought back. So, that, by the way, is good. Fewer shares means that each share is going to be worth more. And we talked about, the guidance. Their revenue is going to be, a huge $369 billion. Wow, incredible. And then we went over earnings per share. The adjusted is expected to be at least $7, and then operating cash flow at least $10.5 billion. So we kind of knew that from the press release. Looking at the quarter, they had, in some ways a better quarter from regards to revenue, but their income was lower than the same quarter last year. I think that's a little bit concerning. So that's probably what's partially driving that stock price reset. Now, looking at the guidance, again, they're really guiding and providing a lot of good information. Some companies, they don't do this, and I appreciate CVS doing it. They really give us all the numbers that we need to revalue the company. From a free cash flow perspective, I'm going to take a very conservative, path, which is take at least 10.5 billion from cash from operations, take away the capex they expect this year, which is going to be 7.5 billion in free cash in 2024. I'll use that as in my valuation model, and I'll use the reset earnings per share. I'll take the lower amount and put that into my valuation. So I took all the updated financial information from CVS and updated my valuation. I value CVS on two methods. First is looking at their free cash flows and trying to get to a net present value of those free cash flows that I expect in the future. And the other is using earnings per share. Let's dive into free cash flow first. So taking the most conservative guidance that they're providing, which is the $10.5 billion less the $3 billion of CapEx, gets us to free cash flow guidance of at least 7.5 billion. So that's a conservative way of looking at it. And then growing those free cash flows in the future by 10%. I'll look at terminal value. All cash flows beyond year 4 are going to grow at 4%. I'm going to discount the company cash flows by 9%. That's going to be our discount rate, which gets us a net present value, an intrinsic value of all those cash flows of $162.8 billion. I'm going to add the cash on the balance sheet and take away debt to get to 115 billion in value, equity value in the CVS business based on their free cash flows. The market cap is 70.8 billion, so it provides a really healthy discount of 64%. I'm agreeing with a lot of those analysts that had a price target much higher. Now, looking at earnings per share. Earnings per share, I'm going to take the very lowest number I can get my eyes on. That's $5.64 this year. I'm going to put the lowest PE on a growing company of 12. Grow those, earnings per share by 15%, which is very doable based on their projections. They're supposed to do much, much higher, but I'll go with 15%. And even putting those low numbers, I get to a stock value of $77.83. Stock price is way down at $56. So there is a discount based on the earnings per share of 39%. When I combine the two, I get a 55% discount on CVS. So that's incredible that this company is being sold off the way it has been. I happen to think that the healthcare sector is one of those stable industries, and it's quite surprising that a stock like this is moving this quickly downward. I think part is sentiment. We are in a stock sell-off. If we look at the last 5 weeks of trading, We are down well over 4% on the S&P if we measure it way back from March 28th. So that might have something to do with it. But I'm a value investor. I'm glad to buy companies when everybody hates them, everybody dislikes them, and I'll buy them at a discount, and I'll see what I want to do with this stock. The balance sheet's really important as well. I don't want a company with a lot of problems, and the CVS balance sheet is beginning to concern me a little bit. Their debt to EBITDA is 3.15, and that's their net debt after you deduct cash is 47.3 billion. Their EBITDA, as best as I can determine it, it's about 15 billion. So it's just slightly over my metric of the debt to EBITDA needs to be under 3. Now, this isn't a big alarm. It's just 3.5, but I'm going to keep an eye on this. If this starts moving up, I'm going to get more concerned. If it moves down, I'm going to get more comfortable. One aspect that I like about CVS is their dividend. Right now, it's a pretty high 4.77, and it's only a 41% payout ratio. So the risk of it going away isn't very high. These guys are buying back a lot of shares. The buyback yield is 2.49%. So collectively, if you add the two, you're well over 7% dividend plus buyback yield. So that's a really nice return. If we could just get this stock price to start moving up, this would be a total winner. So should I buy, hold, or sell CVS? First, let me go over the three main areas that I look at before I make a decision on a stock. First is all about the company. Second is all about the balance sheet. And then third, it's all about the discount. The company. I think the company is a really good company. I really like their management team. I like their strategy of growth. I think they're trying to grow into new areas of business. All those things are really appreciated. And I really like the business. I think it's a solid business. I like the sector that they're in, healthcare. I like that they generate a lot of cash flow. Their brand's good. Their primary peer is Walgreens, and Walgreens has really been having a tough time. And CVS, on the other hand, has really been operating far more efficiently and effectively. So I really like the company. So I'm good with the company. Balance sheet. As mentioned, their debt to EBITDA is a tiny bit high. Now, for now, I give them a passing grade, considering that their revenues continue to grow. They continue to generate high amounts of free cash flow. They're buying back shares of stock. I think their balance sheet overall is in good health. I just need to keep monitoring the balance sheet and make sure that it does not get any worse. Discount. I mean, this is as good of a discount as the market is offering me right now. Analysts agree with the idea that CVS, based on their estimations, is worth a lot more. So having said that, I'm going to continue to buy shares in CVS. And I actually bought $500 of CVS before I filmed this video today on Wednesday, May 1st. I will continue to buy the shares. There's a couple of things that I really like about CVS. And that dividend is one of the things that I really like. CVS is in my income portfolio. And it's a portfolio where I want income out of it so that when I retire, it provides all my living expenses. And this one is a very good stock to put in there. I expect this stock's going to be worth more in 5 years. And if I could lock in my buy price at these high dividend rates that they can afford, I think I'll be sitting pretty with CVS in the future. We'll see. That's my best estimation. Thank you for watching the video. I hope you found it interesting, and I'd love to hear your comments on CVS. You've heard my comments and my plans for my portfolio. I'd love to hear about yours. Love to hear good and bad, your opinion on CVS. It's certainly an interesting time. This year has been a good year so far overall, but the healthcare industry and sector, they haven't been performing all that great. There's a couple of stars like Eli Lilly's been doing great. Cigna's been doing really well, but a lot of other companies have really been doing poorly, including CVS. And I'm still waiting around to see when the healthcare sector is going to rebound and really start doing what it's done historically. If you look at the 5-year or the 10-year historical returns on healthcare, they're excellent. So we'll see when that happens. Anyway, again, I really appreciate you watching, and I really hope you found it interesting.